Welcome to our deep dive into the cost of capital and capital structure. In today's financial landscape, understanding these concepts is crucial for anyone involved in business or investment decisions. We'll start by exploring what capital means for a company, why its cost matters, and how capital structure shapes a firm's financial health. Whether you're a student, professional, or simply curious, this series will guide you through the essentials, examples, and advanced strategy. Let's begin by defining capital and its role in business operations, setting the stage for our journey into the world of finance. Cost of capital is a fundamental concept in finance. It represents the minimum return a company must earn on its investments to satisfy its investors, creditors, and shareholders. This cost is determined by the mix of debt and equity used to finance operations. By understanding the cost of capital, companies can make informed decisions about which projects to pursue and how to fund growth. In this scene, we'll break down the components of cost of capital and explain why it's a critical benchmark for business performance. Capital comes in various forms, each with its own characteristics and implications for a company's financial strategy. The two primary types are debt and equity. Debt capital involves borrowing funds, typically through loans or bonds, while equity capital is raised by issuing shares to investors. Both types have unique costs, risks, and benefits. Understanding these differences helps businesses choose the right mix for their needs and manage their financial obligations effectively. Capital is a common way for companies to finance their operations. It involves borrowing money from lenders, such as banks or bondholders, and agreeing to pay interest over time. The cost of debt is influenced by interest rates, creditworthiness, and market conditions. While debt can provide quick access to funds, it also creates fixed obligations that must be managed carefully. In this scene, we'll explore how debt capital works, its advantages, and its risks. Equity capital is raised by selling shares of ownership in the company. Investors who purchase these shares become partial owners and share in the company's profits and losses. The cost of equity is typically higher than debt, as shareholders expect greater returns for their risk. Equity financing can provide stability and flexibility, but it also dilutes ownership and control. We'll discuss the pros and cons of equity capital and how it fits into a company's overall capital structure. Weighted average cost of capital, or WACC, is a key metric used to evaluate a company's overall cost of financing. WACC combines the costs of debt and equity, weighted by their proportions in the capital structure. This figure serves as a benchmark for investment decisions, helping companies determine whether a project will generate enough returns to justify its risks. Understanding WACC is essential for financial planning and strategic management. Calculating the weighted average cost of capital involves several steps. First, determine the cost of debt and cost of equity. Next, identify the proportion of each in the company's capital structure. Finally, apply the formula. WACC equals EV RE plus DV ARD 1T, where E is equity, D is debt, V is total capital, RE is cost of equity, ARD is cost of debt, and T is the tax rate. This calculation helps businesses assess their financing costs and make informed investment choices. Capital structure refers to the mix of debt and equity a company uses to finance its operations. The right balance can lower the cost of capital, reduce risk, and maximize value for shareholders. Companies must consider market conditions, business risks, and strategic goals when designing their capital structure. In this scene, we'll define capital structure and explain its importance in corporate finance. Several factors influence a company's capital structure, including business risk, asset structure, profitability, growth opportunities, and market conditions. Companies with stable cash flows may favor debt, while those with high growth potential might prefer equity. Understanding these factors helps businesses tailor their financing strategies to their unique needs and goals. Optimal capital structure is the mix of debt and equity that minimizes the cost of capital and maximizes firm value. Achieving this balance requires careful analysis of financial data, market trends, and company objectives. Firms must weigh the benefits of debt, such as tax advantages, against the risks of financial distress. In this scene, we'll explore how companies strive for the optimal capital structure. Choosing between debt and equity involves a trade-off. Debt offers tax benefits and lower costs, but increases financial risk. Equity provides stability and flexibility, but dilutes ownership and may be more expensive. Companies must evaluate their risk tolerance, market conditions, and strategic goals to make the best choice. We'll discuss how businesses navigate this trade-off and its impact on performance. Financial leverage refers to the use of debt to amplify returns. By borrowing funds, companies can invest in growth opportunities and increase profits. However, leverage also magnifies losses if investments fail. Understanding the risks and rewards of financial leverage is essential for effective capital structure management. Debt financing offers tax advantages as interest payments are tax deductible. This reduces the effective cost of debt and can make borrowing more attractive. However, excessive debt increases financial risk and may lead to distress. Companies must balance tax benefits with the potential downsides when designing their capital structure. The cost of debt is determined by interest rates, credit ratings, and market conditions. Companies with strong credit can borrow at lower rates, reducing their financing costs. However, market volatility and economic uncertainty can increase borrowing costs. We'll examine how businesses assess and manage the cost of debt. Cost of equity reflects the returns expected by shareholders. It is influenced by company performance, market risk, and investor expectations. Equity is generally more expensive than debt, as shareholders demand higher returns for their risk. Understanding the cost of equity helps companies attract investment and manage their capital structure. Market conditions play a significant role in capital structure decisions. Interest rates, economic growth, and investor sentiment can affect the cost and availability of financing. Companies must monitor market trends and adjust their strategies to stay competitive and manage risks. Business risk refers to the uncertainty in a company's operations and earnings. Firms with stable cash flows can handle more debt, while those with volatile earnings may prefer equity. Assessing business risk is crucial for designing a resilient capital structure. Nature of a company's assets influences its capital structure. Firms with tangible assets like property or equipment can use them as collateral for debt. Companies with intangible assets such as intellectual property may rely more on equity. Understanding asset structure helps businesses secure financing and manage risk. Profitability affects a company's ability to raise capital and manage debt. Highly profitable firms can attract investors and borrow at favorable rates. Low profitability increases financial risk and limits financing options. We'll explore how profitability shapes capital structure decisions. Companies with significant growth opportunities may prefer equity financing to avoid the constraints of debt. Equity provides flexibility and supports expansion, but can dilute ownership. Balancing growth ambitions with financial stability is key to effective capital structure management. Industry trends influence capital structure choices. Companies in stable industries may use more debt, while those in dynamic sectors often rely on equity. Monitoring industry benchmarks helps businesses stay competitive and align their strategies with market realities. Financial distress occurs when a company struggles to meet its debt obligations. Excessive leverage increases the risk of distress and can lead to bankruptcy. Companies must monitor their debt levels and maintain a healthy capital structure to avoid financial trouble. Several theories explain how companies choose their capital structure. The Modigliani-Miller theorem, trade-off theory, and pecking order theory offer different perspectives on debt and equity decisions. Understanding these theories helps businesses develop effective financing strategies. The Modigliani-Miller theorem states that in perfect markets, a company's value is independent of its capital structure. However, real-world factors like taxes, bankruptcy costs, and market imperfections affect this principle. We'll discuss the implications of this theorem for modern finance. The trade-off theory suggests that companies balance the benefits of debt, such as tax savings, against the costs of financial distress. Firms seek an optimal capital structure by weighing these factors. We'll explore how the trade-off theory guides real-world financing decisions. The pecking order theory proposes that companies prefer internal financing, then debt, and finally equity. This hierarchy reflects the costs and risks associated with each option. Understanding the pecking order helps businesses prioritize their financing sources. Let's look at real-world examples of capital structure decisions. Companies like Apple and Tesla use different mixes of debt and equity to fund their growth. By analyzing their strategies, we can see how capital structure impacts performance and shareholder value. Startups face unique challenges in designing their capital structure. Limited access to debt and high growth potential often lead to reliance on equity financing. We'll discuss how startups manage their capital needs and attract investors. Mature firms typically have stable cash flows and access to debt markets. They can optimize their capital structure by balancing debt and equity to minimize costs and maximize value. We'll explore how established companies manage their financing strategies. Summary: the cost of capital and capital structure are central to corporate finance. By understanding these concepts, companies can make informed decisions, manage risks, and maximize value. We've covered definitions, calculations, theories, and real-world examples. Whether you're planning a startup or managing a mature firm, mastering capital structure is key to financial success. Thank you for joining us on this journey through the world of finance.